Hey everybody, my name is Matt Allen. I work in Activate support. Today we are going to discuss the synchronization between Activate and QuickBooks. We're going to look at how the integration between the two systems is set up, what data actually syncs between the two systems, and which system is responsible for managing what data. We'll get a little bit into the functionality of the sync and discuss some common issues. Let's start with a general overview of what QuickBooks is responsible for, what Activate's responsible for, how it syncs. Generally speaking, since Activate's the inventory management software, think anything that would have to do with inventory is managed in Activate. You have sales orders, invoices, which take product out of inventory, so sales are managed in Activate. Purchasing brings products into inventory, so purchasing is managed in Activate. The accounting side of everything's managed in QuickBooks. So your receivables, your expenses, payroll, all that gets managed in QuickBooks. And then since a lot of the data from Activate obviously has to push into QuickBooks and vice versa, there's data which actually goes back and forth. So you create a customer record in Activate that may be related to a sale. Since that customer has to also exist in QuickBooks, the customers are included in the sync. Since invoices created in Activate need to be pushed over to QuickBooks for the customer account, you can show that they have a balance due. Invoices synced from Activate to QuickBooks. This is really just a general overview of kind of what syncs. We'll get into a lot more detail as to the specific sections of the sync as we go along through the webinar. So I guess let's begin by talking about the integration between QuickBooks and Activate. The initial integration between the two systems starts with what's called the Create Company process. Create Company will actually establish all of the accounts and everything that's in the QuickBooks file and then create it in your Activate Company database. So your list of accounts, even your inventory and your products can be created through Create Company in the Activate database. The most important thing to probably keep in mind there is that all of the accounts in the QuickBooks file have a unique identifier assigned by QuickBooks. It's called an account list ID. So it's like a thumbprint that says this is this account in this QuickBooks file. Where that comes into play is Activate uses that when it runs the sync to say, I'm pushing this journal over to an account in QuickBooks. Activate knows what the identifier in QuickBooks is called, and it knows what account to actually push that value to in the QuickBooks file. That makes it really hard if you want to use a new QuickBooks file or start over with a different QuickBooks file, because even if you have another account that's named Accounts Receivable in that QuickBooks file, the unique identifier will be different. So if you want to use a new QuickBooks file with an established Activate Company database, you would go back through the Create Company process to create those links between the QuickBooks data and the data in Activate. It's possible, you just have to go back through the Create Company. Once the initial establishment's made and the accounts are created, the first time you run a sync with QuickBooks, you're going to have some options as to how the sync is allowed to run. This is set up in the Integrated Applications section in QuickBooks. And when you run the sync, this will pop up in your QuickBooks file, and you'll have to take action before the sync can continue. The first option obviously is no, which means don't allow the sync. The second option, prompt each time, means if you run the sync and Activate with the QuickBooks file open, you'd get this pop-up here saying, can you sync this? If you closed QuickBooks and reopened it, then if you tried to sync again, it would pop up again. So every time you try to sync with a new QuickBooks session, it's going to pop up and require this authentication. The third option allows you to sync when QuickBooks is open. So if I have a user who has Activate open on a workstation and also has QuickBooks open on that workstation, then Activate's allowed to sync with QuickBooks. If QuickBooks isn't open, the sync can't run. One thing to keep in mind is that Activate will run the sync with QuickBooks based on the user permissions of whatever user's logged into QuickBooks. So if the user running the sync, let's say, is logged into QuickBooks and that QuickBooks user doesn't have access to journals, then you'll run the sync and you'll get errors in the sync log saying that journals couldn't be created because that user does not have access to the journals to be able to sync. The fourth option is to allow syncing with QuickBooks even if QuickBooks isn't open, meaning QuickBooks isn't even open on the workstation you're running the sync from, but QuickBooks still allows Acctivate to run the sync. When this is done, you would choose the user rights that are allowed to do the sync with. Usually it's the admin rights, so if QuickBooks isn't open, then you'd run the sync with QuickBooks and it would use the admin rights, meaning you'd have access to everything to allow the sync to run through. If you have that option set, yes, allow access even if QuickBooks is not running. If that's selected and you have the QuickBooks file open, Acctivate will still run the sync as the local user. So it would still use the user permissions of whoever has QuickBooks open. If they didn't have permissions, you would just close QuickBooks, and then if it's allowed to run as the admin, then you could finish the sync and it would push through. So that's how you set up the application, how Acctivate can access QuickBooks with the sync. One other thing that's probably important to keep in mind is we usually recommend installing QuickBooks and a regular file path without using a mapped drive. Some companies will actually install the QuickBooks file into a mapped drive. Where that gets complicated is if a user tries to run the sync and that user's workstation doesn't have that mapped drive set up, it can cause issues with the sync and how it's trying to find the QuickBooks file because it doesn't have an M drive or whatever it would be. So we typically recommend installing it using a regular file path. So with kind of an understanding on how the link between the two systems are created, let's dive into what actually syncs between Acctivate and QuickBooks. Activate's an inventory management software, so think anything that has to do with inventory syncs from Acctivate to QuickBooks. Purchases, sales, all related to inventory, so they're all created and managed in Acctivate and pushed over. We'll start with inventory and how inventory actually syncs. Obviously, inventory is managed in Acctivate. Transactions like receipts or adjustments, even sales, get batched into journals, which then write to QuickBooks accounts. The type of transaction line dictates what account gets used in the sync and where everything writes to. And you can configure those accounts in Acctivate in Configuration Manager. The accounts for different kinds of transactions can be unique from one warehouse to the other. So you could have your inventory asset account in your main warehouse and a different inventory asset account in your California warehouse or whatever it is. Or you could have everything uses the same accounts. It's really preference there. But when you look at the warehouses and how they're set up in Acctivate, you set your inventory account, and then you set where your purchases go and what account your adjustments hit. And this tells Acctivate where the other side of a journal posts to. Any transaction which adds or removes inventory value is going to hit the inventory asset account. So if you post a receipt to add value, it writes to your inventory asset account and adds value, and then offsets to the accrued purchase receipts account. And if you posted an adjustment which removed value from inventory, then it would take away from your inventory asset account and would write to your inventory adjustment account. And these accounts can all be configured. This is however you want to set these. And again, it can be different from warehouse to warehouse. So it looks like D and F use the same accounts for demo, but you wouldn't have to. For example, let's say you have a product that's stocked in your main warehouse. Acctivate says that you have 10 on hand in that warehouse. You walk out to the warehouse and find that you only have 8, and you need to update Acctivate's inventory. Be a transaction posted incorrectly, a receipt that brought in too many, maybe a product fell off the shelf and broke. Regardless, you'd need to set the on-hand quantity in Acctivate to be accurate so that you're showing what you actually have. To remove the overstated inventory, you'd run an adjustment. Here's an adjustment where button was in the D warehouse and I had too many, and so I had to take 2 out, and it shows 2 got removed at 10 each, so $20 got removed. And while that's the transaction, I can also look at that in the journal itself using the inventory detailed journal report, which is super handy. And I can look at that very same session here, and this will show me how it actually writes into the QuickBooks file. So here's the journal entry number 1146. There's the session 43, quantity of 2, $20 gets removed, and it shows your inventory asset gets debited, your inventory adjustment gets credited because this is an inventory adjustment type transaction. Activate is going to batch like transactions into journals based on what has posted since the last sync. If I ran a sync at end of business last night and I came in this morning and I posted 8 new receipts and 3 new adjustments, then Activate would batch all of those 8 receipts into one journal, and then it would batch those 3 adjustments into a different journal. And then the sync time advances, and then the next time you run a sync, all the new transactions get batched again into new journals. Here's a journal 1148, which has inventory receipts. This particular journal happens to contain session 46 and 45 and 47, so 3 different receipts, all on the same date, because they'll batch together based on date. Even if you haven't run a sync in 5 days, it's not going to create one journal record because it has different sessions that hit on different days. So it's obviously batching like transactions by date, and then it shows you where it hits. This is going to add to inventory. We're adding $40 to inventory, $105, and it offsets to the accrued purchase receipts account because this is an inventory receipt type transaction. I can take a look at another journal here, 1149, and see 1149, while it uses the same transaction date, this has inventory adjustments, and this has session 48, 49, 50, these 2 added value, this one removed value. Still, it's hitting your inventory asset because every inventory transaction hits your inventory account, and it's going to offset based on the transaction type. Since this is an inventory adjustment, offsets to your adjustments account. So pretty straightforward in how those are set up. One thing you may be asking is where the sales go. Account listings by warehouse, there was nothing set for sales or cost of goods sold accounts. And that is because Activate can do this one of several different ways. So here in Configuration Manager, you can set how the accounts are selected. Most common is a product class. So if I set the accounts to be selected by the product class, go to inventory and I look at the product class, I can see the sales and COGS accounts. So if I wanted to do this, then I could say furniture goes to this sales account and that cost of goods sold account. And if I sell a product that uses the equipment product class, then it uses different accounts. Again, you can have these separate, you can have these all the same. It's however you really want to set it up. But this isn't the only option. You could also do by, say, branch. So if I look at branch right now, I can set the AR account and the invoice account, but there's no sales or cost of goods sold accounts. If I change my account selection to be based on branch, now I can see, I can set a sales or COGS account. At the same time, I can look down here at the product class, and now those accounts aren't there anymore. How your sales and how your cost of goods sold actually write to QuickBooks depends on how you want Activate to manage your sales and COGS. And then from there, you'd set your accounts to be, whatever they're supposed to be. Next, let's talk about customers and how the customer sync works between Activate and QuickBooks. Customer sync is very unique because it is the only section in the sync that actually goes both ways. Meaning I can make a change in QuickBooks and it updates Activate. I can make a change in Activate and it updates in QuickBooks. Just about everything else that syncs between Activate and QuickBooks is managed in one system and pushed to the other. Customers are really unique. It's based on timestamps. Whichever system, whether it be Activate or QuickBooks, has had the most recent change, the sync looks at the system and says, a change has been made more recently in Activate than in QuickBooks, so it knows that the information in Activate needs to override the information in QuickBooks and vice versa. Ruby Baker is set up here, and I could change her address here to be Fort Worth, and I could change the zip code to 76026, let's say, and the change gets made in Activate. When I make this change that says that this is different, it updates the timestamp record in Activate, and the sync with QuickBooks looks at that timestamp. If I pull up Ruby Baker in QuickBooks, see, it still has Arlington 76011, which was set before. Also, I guess I can mention here in the sync, you can specify the synchronization options. So if you only want to sync customers without their invoices, you set it to customers. If you don't want to sync vendors or accounts payable, you can say no. And it just dictates how the sync runs faster or slower, but it doesn't advance the sync time for other sections if those aren't included. So we can see here, we've made the change to the record in Activate. I run a sync with QuickBooks. I take a look at Ruby Baker, and it makes the change. And then if I make that change I can make a change in QuickBooks to the customer record, and I can say now this customer has a different address the timestamp updates in QuickBooks to be newer than what was in Acctivate. The sync runs and reviews that it's newer now in one system than the other. So if I run another sync, it updates the record in QuickBooks to have the new address because the change was more recent in QuickBooks. So again, this is the only section that really goes both ways, and it's all based on the timestamps, which system is more recent. This also means that there is no reason to really make changes to customers in both systems. It gets probably a little sticky if you make a change in Acctivate to say, hey, flag this to be changed in QuickBooks, and then you make a similar change in QuickBooks, and both systems would try to override each other. It'd still be based on the timestamps, but generally we would recommend having some sort of a process where you're either managing customers in Acctivate or QuickBooks, and since the customer views on your sales in Acctivate, it's usually recommended to update and manage your customers in Acctivate and push changes over to QuickBooks, but that's totally different from one business to another, so it just depends on how you want to manage things, but that's how the customer section actually works. Moving on, since we kind of understand how the customers sync between QuickBooks and Acctivate, let's talk about how the customer invoices actually sync between the two systems. Invoices can be created in either system. So you can create a sales invoice in Acctivate from a sales order, or you could create an invoice for the customer in QuickBooks, and the invoice itself would sync to both systems. So if I create an invoice in Acctivate, it pushes the invoice to QuickBooks for the customer record. If I create an invoice for the customer in QuickBooks, it will create the invoice and you'll see it for the customer in Acctivate, but it doesn't actually affect your inventory. So when you post a sales invoice in Acctivate that says, I'm selling 10 of this product at $10 each and customer owes me $100, then it will actually take those 10 of that product out of your inventory, which relieves your inventory asset account. It takes it out of your inventory asset. It writes it to your cost of goods sold account, depending on how you have that configured. And there's a whole lot more that takes place relating your inventory when you invoice and Acctivate. If invoice is created in QuickBooks and comes over to the customer, all you can really see is here's an invoice amount, and the customer either owes a balance or they don't. So you can see it related to the customer, but it doesn't actually have any functionality. Typically, we would recommend doing all sales and invoicing in Acctivate since it hits your inventory. If you do sales and invoicing in QuickBooks, it's going to cause issues because it's not going to relieve your inventory. You would have to go into Acctivate and post some other kinds of transactions like adjustments to remove the excess inventory, and then it's hitting your adjustments account and not your cost of goods, which is not what anybody wants. So we would usually recommend managing your sales and invoices in Acctivate. Here's an example. I have two different invoice records for Ruby Baker here. I can pull up this invoice, the 3336Z invoice, and notice I have distinct product IDs here. I have line numbers, and these are products that are set up in Acctivate, and I have this view order button where I can see the sales order that this was created from. So I know in Acctivate that this invoice was created from this sales order, and this was created in Acctivate. This is going to hit my inventory. Then I can pull up this invoice record and Acctivate for Ruby Baker, and notice it just has the generic product class, just equipment, because it doesn't actually have the product IDs. The product IDs aren't in QuickBooks. Notice there's no view order button that I can view. So this invoice was just created in QuickBooks, and it doesn't affect inventory in any way. Another important thing to keep in mind is that while invoices technically can be created in either system, it is not a two-way sync, meaning that changes made to an invoice created in Acctivate are not going to update if the change gets made in QuickBooks. So if I have an invoice that posts on 3/7/2018 and it syncs over to the QuickBooks file, and then I change that date from 3/7 to 3/8 in QuickBooks and run another sync, it doesn't change the date of the invoice in Acctivate. You'd get a warning in the sync that shows this invoice changed in QuickBooks from this date to this date. So you get a warning that said something changed, but it wouldn't actually change the record. What would happen is now you would have an invoice in QuickBooks that has one date and the same invoice number in Acctivate with a different date. So if the invoicing is done and managed in Acctivate, then any changes that need to be made to that invoice need to be made in Acctivate. So if you release an invoice and see that the salesperson was wrong, then you would need to void the invoice as it is in Acctivate, make the change to the salesperson, re-release the invoice in Acctivate, and then it would update in QuickBooks. Even if it's already synced over, Acctivate would then go in and say, this invoice no longer has this data, now it has this data instead. Understanding kind of how the invoices sync with QuickBooks, let's move into payments and how payments actually sync with QuickBooks. First of all, payments and how they work in Acctivate really depend on payment methods, which are created and managed in QuickBooks. You go to your payment method list in QuickBooks, you create a new payment method, run the sync, and then it pushes over into Acctivate. But the payment methods themselves are actually managed in QuickBooks. You create and modify payment methods in QuickBooks, and then it pushes over into Acctivate. Within Acctivate, credit card check is really important because it dictates what payment methods you can actually use credit card information for and to charge credit cards. On that note, payments can actually be managed one of two different ways between QuickBooks and Acctivate. So method one is you create the sales invoice from a sales order in Acctivate. You run a sync to create that invoice in QuickBooks, and then apply the payment record to the invoice in QuickBooks, run another sync, and the payment record's in Acctivate. It gets created and it's applied. The other option is to actually charge a credit card at the time of invoicing in Acctivate, which means that the payment will be created at the same time as the invoice, both in Acctivate, and the following sync would then push both the payment and invoice into QuickBooks. Again, if you are charging cards, you'll have a credit card processor set up in Acctivate, like Intuit Merchant Services or Authorize.net, and it would actually go through the credit card processor, which would then run a check and say, yeah, this is okay, this is approved, or it's declined, and it would come back to see if you could create the payment record and then apply to the invoice and syncs over to QuickBooks. I can kind of show how that would look. Here's a Bayshore customer, and I have an invoice record here, which has an amount, and I can see the whole balance is due, meaning this payment hasn't been applied. No payment's been applied to this invoice record. In QuickBooks, I can pull up that same customer. There's the 1309. So in this example, we created the invoice in Acctivate, ran a sync which creates the invoice record in QuickBooks. Then I can receive payments. Now the payment's been created in QuickBooks and applied to the invoice record. If I go back to Acctivate, run a sync to bring it over, it'll actually pull that payment record from QuickBooks, apply it to the invoice in Acctivate, and that's one of the methods for applying payments to invoices. And now nothing's here because it's a zero balance item because I have this invoice and now I have the payment record that paid it off because it came into Acctivate. One thing that's important to keep in mind when voiding an invoice where the credit card payment was actually created in Acctivate, since the charge is made and the payment record doesn't exist in QuickBooks yet because you haven't run a sync, if you were to void the invoice in Acctivate, it would send the charge back and void the charge back through the credit card processor. So here's the invoice, I'm releasing the invoice, I'm charging this credit card in Acctivate, hits the credit card processor, comes back and says, yep, it's good, card's charged. If you immediately say, oh, the salesperson's wrong on this invoice, I need to change this, you void the invoice and then the charge gets sent back to the card, you can run into some issues. Let's say you have a customer that has a $1,000 daily limit on their card and you have a $600 invoice. Well, if you charge the $600 and it comes back and everything's fine, then you void the invoice. It voids the charge on the card, but that's not going to fall off of their available balance until the next day. So you turn around and try to recharge the card again, and they don't have enough available balance on their daily limit to charge. And now you have to wait till the next day to actually charge their card. So that's no good. Instead, what's recommended is once the invoice has been created and the original charge is created, sync to create the invoice record and payment in QuickBooks. Once the payment's been created in QuickBooks, once that sync's been done, when you void the invoice and Acctivate, it doesn't send anything back to the credit card process. It's already been created in QuickBooks. You'd even get a warning that says that the payment's not going to be voided when you void the invoice. So if you need to make a change to an invoice and you're charging cards in Acctivate, it's typically recommended that you first run the sync to create the payment, go back into Acctivate, void the invoice to make whatever changes you have to make, and then resync the invoice which goes back into Activate. You don't have to charge a card twice. There's only one actual transaction that hits the card without voiding. It's kind of a caveat there where things get a little bit complicated with purchasing. Let's move along to our purchasing section and how purchasing actually syncs between Activate and QuickBooks. The process of purchasing is designed to add inventory to Activate, so purchasing is managed in Activate. The purchasing process is actually a two-step process. The first step is to establish your inventory, which is done with a receipt, and then you create the PO invoice from that purchase order, which pushes over to QuickBooks as a vendor bill. Both of these are going to hit different accounts, so maybe take a look at how that looks in Activate. Here is a purchase order, which I've entered to buy this product with a negotiated price. I can see it hasn't been received yet, so step one in the process is to create a receipt. So on 2/15, a truck rolled into my D warehouse and dropped off one of this chair, and I'm telling Activate, this is the quantity that came in, this is the cost that came in, this is the warehouse that came in, this is the transaction date, this is when it came here. This actually drives your inventory. This transaction is going to add to your inventory asset. So I post this receipt from Activate, and I can run the sync with QuickBooks, and that receipt transaction gets batched into a journal. Because it's an inventory receipt transaction, it's going to hit whatever my GL account is for purchasing, which, as I recall, was the accrued purchase receipts account. Now that that's done, I can take a look over here in QuickBooks, pull up my chart of accounts and look at my accrued purchase receipts. And if I look on 2/15, it creates the transaction, which adds value. It increases because it's a receipt, and you can see the offset to your inventory asset. So it hits your inventory asset account and then offsets to this accrued purchase receipts account. This is really just a holding account. It's going to stay in accrued purchase receipts, and then when a PO invoice or vendor bill is released in Activate from that PO, that value gets moved out of accrued purchase receipts and posts over to your accounts payable account. This is done because you may do batches, so you may have 5 receipts which are received over the course of 6 months, and your vendor has agreed to terms where you simply pay them at the end. So instead of doing one receipt, pay for that, another receipt, pay for that, a month after that, another receipt, pay for that, they're saying, we're going to send you 25 now, 25 next month, 25 the month after that, and once we're done, we've shipped you all of those, you can pay for them. So the receipt establishes inventory, which is accurate. This is the date that the product came in, this is the cost that the product came in, and that drives the cost and gives you available inventory that you can sell and use in Activate, but without the actual bill which moves to your accounts payable. Now, because Activate wants that to be a one-to-one relationship, so the value that gets added from the receipt needs to match the same value that gets removed by the vendor bill, the PO invoice. The PO invoice in Activate actually dictates the receipt. So if in this case, I posted here this receipt that I posted at $100, which adds $100 to my inventory asset, and now it's time for me to pay my vendor, and my vendor tells me, hey, this isn't actually $100, this is actually $110. Since that's what you're actually paying your vendor, that's the real cost of what you're paying for this product, Activate updates the posted receipt to match. So here I put in my PO invoice with today's date. The approved price is set to $110. When I create this PO invoice and Activate, it shows me that there's a receipt that's been entered. The unit cost in the receipt doesn't match the price that I just approved. In order to post this, it has to update the receipt to match. So this is Activate saying your receipt was posted using one cost, and now it has to be updated to use a different cost. It completes. I can sync with QuickBooks, which will it'll update the posted receipt transaction and the journal that was batched into to show the updated value, the 110 instead of the 100. And then the bill will also post, which will remove the value from accrued purchase receipts and move it over to your accounts payable. So in QuickBooks, if I look over here, I can see here's bill 328.18, where $110 is removed from accrued purchase receipt and offset to accounts payable. And then so that everything balances, it finds the posted receipt and updates the cost on that receipt to match. Where this can get complicated is when your receipt may be in a closed accounting period. So since those balances have to match, the receipt cost and the PO invoice have to match. One thing where you can kind of get into trouble is if let's say that receipt posted on 2/15 at $100, and on March the 10th, I set the closing date in QuickBooks to be February the 28th. I closed the accounting period for QuickBooks for February. Now I can't make any adjustments. Now I go to pay my vendor bill on today, 3/28, and vendor tells me there's a different cost. Well, Acctivate wouldn't be able to update the posted receipt because now it's in a closed accounting period. And so in order to make those adjustments match, since the vendor bill is 3/28 still in an open period, the vendor bill's still going to move $110 from accrued purchase receipts to your accounts payable, but it can't update the posted receipt. So Acctivate creates what's called a prior period adjustment line, which sounds scary. It sounds like Acctivate's making changes in a prior period, but in reality, Acctivate's accounting for a prior period and making the adjustment as of the first day in the open period. So in our example, $100 gets written by the receipt. The PO invoice is $110. I can't update the receipt on 2/15 to change from 100 to 110. So as of the first day in the open period, March 1st, Acctivate writes a $10 entry into the accrued purchase receipts account, which now balances with what the vendor bill has removed from the account, and the prior period adjustment line posts on the product to update the cost. This gets into a difference between your transaction accounting period or your transaction period and your accounting period. Just because you're closing your books and saying my accounting's done for February, well, if a receipt posted in February and that cost is not correct, it should be $110 instead of $100, then your account would not be accurate in the closed accounting period. Acctivate, like I said, the prior period adjustments try to adjust for this, but it's usually recommended whenever you're going to close your books, go in and take a look at anything that's pending. If you have receipts that have posted that might update in their cost, consider that before you close the books off, because it can cause these prior period adjustment lines, which occasionally don't make a lot of sense to people when they first see them. Another thing that's important to keep in mind with purchasing, receipts that are posted without purchase orders cannot have vendor bills that move the value. So you would just have one line in the receipt transaction, writes to your inventory asset and offsets to your accrued purchase receipts. But since it's not tied to a PO, there will be no vendor bill. There's nothing to move that value from accrued purchase receipts to your accounts payable. So it just waits there until someone takes some sort of an action. Typically, you would use like a general journal to move that value from your accrued purchase receipts to your accounts payable. But just one thing to keep in mind, if you're posting receipts independent of purchase orders, it can cause your accrued purchase receipts account to grow. And we get, people ask us all the time, why is my accrued purchase receipts account growing? Usually it's because receipts are posting independent of purchase orders. It's something to keep in mind. While purchase orders and receiving are managed in Acctivate, the vendors related to those transactions are actually managed in QuickBooks. So any changes related to a vendor, if you want to change their contact information or their address information, all those changes would need to be made to the vendor in QuickBooks, and you run a sync that's created in Acctivate. So Acctivate is very similar to how the customer sync works, except Activate's utilizing the vendor center in QuickBooks to make changes. So you'd only make the changes in the one system, and they'd push over and update after the sync. So vendors are managed exclusively in QuickBooks. We can move on to tax and how tax works. Sales tax is just a percentage which comes into Acctivate and is created as tax categories. In QuickBooks, you actually go to your item list. You would have a Dallas City sales tax, 0.25%, and here's Dallas Transit Authority's 0.25%, and here's the sales tax item that get grouped into a sales tax group. So 0.25 for Dallas MTA or Dallas Transit, 0.25 for Dallas City, 6.25 for Texas, and the Dallas group has a 6.75% group rate. Activate then just brings those over. You can see them in Configuration Manager. They come over as tax categories. But if you need to create a new tax category, or if you need to change the percentage, let's say sales tax is modified for wherever you're selling, all those changes and modifications would need to be made in QuickBooks and then pushed over into Activate. You can see the group of Dallas sales tax group is active because that's a tax category, and the individual items are not because you would use the sum of those parts. But that's how tax by default is created and Activate. Next, I guess we can move on to Salespeople. Salespeople, again, are created exclusively in QuickBooks and managed there. So if you have a new salesperson, if you want to make changes to the salesperson, you make the change in QuickBooks on the sales rep list, you run a sync, and it updates those changes in Activate to show the new salesperson or updated salesperson, whatever's different, but that's exclusively managed in QuickBooks. Any new accounts obviously are created in QuickBooks and managed in QuickBooks. If you had inventory that's been managed in one account and you have a new warehouse and you want to split it and make a new inventory account, new accounts would be created in the current QuickBooks file. It wouldn't replace your existing accounts. It would just make new ones. If you want to change the name of an account or something like that, you can do that in QuickBooks, and then Activate would see the change. One thing that's very important to keep in mind, if an account has ever been used in Activate, do not delete or merge accounts in QuickBooks, because existing data in Activate is referencing those accounts, and if they go away in the QuickBooks file, it can cause a whole bunch of problems. Often, we've seen where it causes so many issues that companies would have to restore database sets, and you lose data, and that's not anything anybody wants to go through. Do not delete or merge accounts which have ever been used in Activate. That's the major sections of the sync. In addition to that, currencies in QuickBooks are, if you have multiple currencies, currency and currency exchange rates would be set in the QuickBooks file. So if you wanted to start using Great Britain pound, you would go into QuickBooks, add the multi-currencies, set what the percentage is. If that percentage ever changed in QuickBooks, you'd make the change in QuickBooks, run a sync, and it comes into Activate. Same thing with terms codes in QuickBooks. If you have a new terms code that you want to use or update an existing terms code, you update it here and say, net 10 has 10 days. Well, change that or add a discount or whatever you want to do. New terms, updated terms managed in QuickBooks and synced into Activate. Product classes are managed in Activate and then synced over to QuickBooks. So in Activate, if you wanted to make a new product class, we had equipment and furniture and things like that. The creation of the product class gets done in Activate. Here, product class, and then in QuickBooks it moves over as an item. So if I look at my items list there, I can see furniture, equipment. They come over as non-inventoried parts and get created in QuickBooks. That's basically everything in the data that syncs. The functionality of the sync is based on timestamps, and we went over that a little bit with the customers, but Activate has a table called the sync time. Sync time shows all the different sections. This is the actual Activate database, and it shows a sync time, which is the last time a successful sync was run for that section. So I ran a sync today at 1:39 p.m. for customers. It completed, so this sync time advances. If there was an error with customers, the sync time doesn't advance, so that you can fix whatever the issue is, and Activate knows to make the changes. These timestamps dictate the sync, and they actually are reviewed in both systems. One important thing to keep in mind that comes up pretty frequently is we'll have a company that does verify and rebuild of the QuickBooks file or an update to QuickBooks. What that does is it updates all of the timestamps of all of the data in the QuickBooks file. So if the sync time is set to 3:28 at 1:40 p.m. and I run an update to QuickBooks, the timestamps on all of those are going to be, right now, this second. If I run a sync immediately after that, it's going to look at all of the data, not just new data. we can't really do anything on our end because the timestamps are there. What you would have to do is wait for the sync to finish, get past all of those to give a little green check. When you get the green check that says there's no errors in this section of the sync, it advances the sync time. And then the next time you run a sync, it's only going to look at data which is new or been updated since the last sync was run, just like with customers. It's generally designed to only sync things that are new unless you have a problem, so that it doesn't advance past it. You can go back and fix whatever the issue is and then resync everything. One thing that run into fairly frequently with the sync times are syncs that get abandoned. If you ever run a sync and you just done an update to QuickBooks and you've been syncing for 30 minutes and you normally take 5 minutes, if you end task and manually stop the sync, there's no functionality in Acctivate that says there was an end task, and it's not because there's no function that's taken place in the system. In the database, you see this in progress state, in progress user. So if you were in the middle of syncing, let's say invoices, your user and what time you were syncing is set here. And when you end task, Acctivate doesn't know that the sync ever stopped. It assumes it's still running. You would turn around, run another sync for another 30 minutes until you'd get to the same place you were in the previous sync, and it's going to stop because Acctivate thinks that the previous user is still running a sync. So never abandon a sync. Even if it takes a long time, it's best to let the sync finish, let those sync times advance as much as they can, and then after 24 hours have passed, you're back to normal syncing times. A couple common issues that I guess I can go over here with the sync before we go. The closing date is a big thing that comes up quite frequently. When the closing date is set, Acctivate doesn't know that the closing date's been updated until you run a sync. So if I set the closing date last night to be, whatever, all day today before I run another sync, Acctivate doesn't know it's been updated and allows you to post transactions. It may allow you to post transactions in what is technically now a closed period in QuickBooks because it doesn't know better. Then you run a sync and you get all these closing date errors that say Acctivate can't write this journal over because it's in a closed accounting period. To avoid this, we recommend running a full sync that doesn't have any errors. So everything that needed to batch to QuickBooks is batched. Set the closing date in QuickBooks to be whatever you want it to be, and then turn around and sync immediately so that Acctivate can see the updated closing date and prevent you from posting transactions in the closed accounting period. Merge customers is another thing that comes up quite frequently. You can merge 2 customers in QuickBooks, run the sync, and Acctivate will merge the 2 customers in Acctivate. Where we've seen some issues with that, it involves the closing date. So if one customer has transactions in a closed accounting period, QuickBooks will prompt you to put in the closing date password to allow the merge on those customers, but that doesn't change the closing date in Acctivate. So when you're merging customers in QuickBooks, take a look at the oldest transaction for either of those 2 customers, and you would need to set the closing date in QuickBooks to be the day before those posted transactions so that the effects can take place in Acctivate. Otherwise, you're going to get closing date errors saying Acctivate's trying to update this old transaction to move it from this customer to that customer, and it can't because the closing date's set. So that's something that comes up pretty frequently. Duplicate entries are common, where you'll have invoice 123, which is in QuickBooks, and then you'll look again after another sync and you'll have invoice 123 for the same customer on the same date. This is because that unique identifier from QuickBooks doesn't get written to Acctivate, so the Acctivate database doesn't know the invoice record ever synced to QuickBooks. It's just an error in the sync. And then the next time you run a sync, Acctivate pushes it back over again. In QuickBooks, you can't tell which record is actually linked to the Acctivate data and which isn't, so we recommend deleting both entries from the QuickBooks file, which would put them into a deletion log in QuickBooks. When you run another sync again, Acctivate will see, oh, this Acctivate created invoice has been deleted from QuickBooks, and so I need to recreate it. And Acctivate will push the single record back over. And we see that sometimes with invoices, sometimes journals. The fix is usually really, really easy just to delete both records and push it over. But it's important to keep in mind, Acctivate does review that deletion log. And if something's been removed from QuickBooks, Acctivate's going to try to push it back over again. I think that's about it. That's pretty much all the different sections of the sync and the functionality and how everything works. If you have any questions, obviously, you can create a support request or ask us on our help site. We try to keep it as updated as possible, especially with syncing. You can look up the sync error in our help site, and there'll be an explanation as to what caused it and what you can do to go about fixing it. I guess that's it for me for now. Again, if you have questions, just let us know on our help site. Thank you very much for your time. You guys have a great day.